Ladies and gentlemen, good day and welcome to the Tega Industries Limited Q2 and H1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Varun Jain from Dolat Capital for opening remarks. Thank you, and over to you, sir.
Good evening, everyone. I'm very delighted to welcome everyone on the Q2 and H1 FY26 earnings conference call of Tega Industries. So today we are joined by the management, Mr. Mehul Mohanka, MD and Group CEO, Mr. Sharad Khetan, the Chief Financial Officer, and Mr. Prateek Basu Roy, President, Product Management, Global Sales and Marketing. And the management will deliver some opening remarks followed by the Q&A.
Good evening and a warm welcome to all the participants on the call. I am joined this evening by Mr. Saurav Sen, CEO of Tega McNally, Mr. Prateek Basu Roy, President, Product Group and Sales, and Sharad Khetan, our CFO. Thank you for joining us today. It's a pleasure to connect with our valued investors, analysts, and stakeholders. As we close the quarter ended September 30th, 2025, Tega Industries remains focused on sustainable growth, leveraging our strengths to overcome market volatility and capture emerging opportunities. I'm pleased to share our performance highlights for the quarter and the first half of the fiscal year. For Q2, our consolidated revenue stood at 4,211 million rupees, representing a 15% year-on-year growth, driven by strong demand and operational execution. For the first half, consolidated revenue reached 7,927 million, up 10% year-on-year, reflecting consistent momentum across our businesses. Our focus on operational efficiency continues to deliver results. We reported an EBITDA of 849 million rupees for Q2 and 1,561 million for H1, maintaining healthy margins of around 20%. I'm pleased to share the strong performance of our equipment business, which delivered revenue of 707 million, a robust 55% growth year-on-year compared to 456 million in the same period last year. Looking ahead, we remain confident and on track to achieve our FY26 earnings guidance, supported by strong fundamentals and strategic initiatives. As of September 30th, our order book stands at approximately 11,556 million, with 7,306 million scheduled for execution over the next 12 months. This gives us strong visibility into near-term revenues and reinforces confidence in our growth pipeline. Looking forward, we maintain a balanced outlook. While global macroeconomic headwinds remain, our diversified portfolio, resilient balance sheet, and customer-first approach equip us to navigate volatility and capture opportunities in key markets. Our focus remains on delivering sustainable growth and creating long-term value for stakeholders. On the Molycop Tega transaction, we are pleased to confirm that the process remains on track. We are progressing through regulatory approvals and execution of definitive documents. As planned, we will continue to keep our investors informed as key milestones are achieved and share timely updates on the developments. I want to thank all our employees for their unwavering commitment, our customers for their trust, and you, our investors, for your continued support. We are committed to delivering sustainable value and transparent communication. Now I would like to hand over to Sharad, who will take you through the financial performance of the company.
Thank you, Mehul. A very warm welcome to everyone, and thank you once again for joining the earnings call for Q2 of FY26 and H1 of FY26 performance and results. The total group revenues for Q2 FY26 stood at rupees 4,111 million, with an EBITDA of rupees 849 million, that is, an EBITDA margin of 20%. The group revenues for the same period last year, that is Q2 of FY25, was at 3,668 million, with an EBITDA of 478 million rupees and an EBITDA margin of 13%. In comparison to last year, the revenues improved by 15% on a quarter-to-quarter basis. During the current quarter under reporting, the consumer business segment and the equipment business segment contributed 83% and 17% the group's revenue from operations respectively. The revenue from operations of the consumer business reported revenues of rupees 3,389 million in Q2 of FY26 vis-a-vis 3,094 million same period last year, that is marginally up by 295 million rupees or 10%. While we have witnessed some disruptions due to global economic and political developments, war, logistics, supply chain disruptions, sanctions, tariffs, etc., the overall business is unaffected and the sales funnel is robust. The revenue from operations of the equipment business witnessed a significant increase of rupees 251 million or 55% with Q2 of FY26 revenues at 707 million as against rupees 456 million reported during same period last year. We have maintained healthy gross margins in Q2 of approximately 59% at the level vis-a-vis approximately 53% same period last year in spite of raw material volatility, global uncertainties and a higher share of the equipment segment. The order book for both the business segments, that is the consumable business and the equipment business, remains strong. We have an order book of rupees 11,556 million as of 30th September 2025, out of which executable orders within 1 year is rupees 7,306 million. The total group revenues for H1 of FY26 stood at rupees 7,927 million with an EBITDA of rupees 1,561 million, that is an EBITDA margin of 20%. For the similar period last year, that is H1 of FY25, the group revenues was at 7,184 million rupees and an EBITDA of rupees 1,237 million with a group EBITDA margins of approximately 17%. On a year-on-year basis, the total revenues have grown by approximately 10%. On a H1 basis, the gross margins have shown a significant improvement of 300 basis points, roughly from 56% to 59%, mainly on account of regional and product mix, specific execution of high margin orders. The equipment business saw considerable growth in the bottom line with increased revenue and improved EBITDA margin from approximately 5% last year to the current levels of 14%. There has been considerable easing on transportation, freight, supply chain concerns, with shipment time, freight costs coming down, with the availability of containers becoming a lot more easier than in the recent past. With the Middle East conflict easing, the Suez Canal is open for traffic now, and the traffic is slowly showing improvements. The shipping companies are making a gradual return to the canal as stability in the Red Sea. We are keeping a close watch over the situation and have also proactively taken actions to ensure raw material security by advanced placement of orders, firming alternate vendors and shipping routes, dispatch readiness in time, reduce manufacturing time to offset the increased timeline, and are tracking all the shipments on a real-time basis. The risk related to the recently imposed tariffs by USA is changing every day, and the de-risking plan has been put in place to offset the impact, if any. The mainland USA accounts for roughly 2 to 3% of our total revenues, and the impact of US tariffs globally is still unfolding, and we are keeping a close watch on the developments. We have made manufacturing of products for USA from alternate manufacturing locations, which are less affected countries like Chile. The Chile Capex project is on track with the project in full action, and we shall have the same ready for commercial production by Q2 of FY27. It may be noted that no sales shall be impacted in such interim period as we have put up alternate plans at Chile, which we shall address any capacity limitations to meet the revenue growth. Thank you very much for your time, and the forum is now open to questions you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We will wait for a moment while the question queue assembles. The first question comes from the line of Chirag from Centrum Broking. Please go ahead.
Yeah, thank you. So, sir, firstly, on the consumable segment, in H1, we have grown by around 3% with a margin of around 16.5. So, normally we aim to grow annually by 15% and have an annualized margin of 22 to 23%. So based on the delivery schedules, etc., is our H2 looking strong enough to, meet these goals, or we feel that FY26 could be slightly lower?
Chirag, generally, if you see traditionally, our H2 is always heavier than H1. And if you see the Q2 results over Q1 and Q2 of this year versus Q2 of last year, you will find significant improvement in the revenues and the EBITDA margins. We are committed to the full year estimates, and we hold on to our guidance as we have given over. These are only reasons for spillover to the subsequent periods.
Okay, sir. And sir, on the Chile capex, in your opening remarks, the voice was not very clear. So, you mentioned the updated timelines of Chile project commissioning and what?
In last investor call also, we had said that it will be by September of 26, and that is what I have mentioned in my opening remarks. That is Q2 of FY27.
Okay, so it remains on track for September.
Yeah, it remains on track. Yeah.
Okay, sir. Any qualitative remarks you mentioned regarding easing of freight, transportation, etc., in terms of overall global demand, competitive intensity, etc., any concern that?
No concerns as of now, Chirag.
Okay. And sir, one last thing on our Molycop acquisition. So we have done 2,000 crore worth of capital raise. Henceforth, for Molycop financing, we expect further 1,000 crore of debt on the Tega books, which were originally planned. So any timeline on that and any further capital raise likely beyond this 2,000 crore?
This is Mehul. We will be doing another small equity raise of about anywhere between 400 to 500 crores to complete the entire equity raise. Because if you remember in our presentation also, we mentioned that the total equity requirement is 2,300. So we are about 300 to 400 crores short. So we will be soon raising the balance. I'm not yet sure whether we'll do it in the form of QIP or pref allotment, but that's what we're going to be doing. And the debt part of it is 1,000 as of now. The debt commitment is closed, but we may revisit some of that to see if we really require 1,000 or a number smaller than that.
Okay, so when the timeline of 31st December, 1st January remains as it is, as far as your expectation of approvals, etc. is concerned?
We're expecting end December, but it may spill over to January because the timelines when it comes to regulatory approvals is not really in our control. But I'm just sharing with you what has been given to us as guidance by our councils.
Okay. Sure, sir. Yeah. Thanks. Those were my questions. Thank you.
Thank you.
Thank you. Participants wishing to ask questions may press star and 1. The next question comes from the line of Varun Jain from Dolat Capital. Please go ahead.
Hi, sir. So, at the start of the year, I think you had guided equipment business revenue growth of 25%, and now it seems we massively overshooting, more than doubling that in FY26. So, sir, what happened? Any reason why such a bumper growth has come?
So it has been backed by a strong order book in the equipment business, as well as the execution has been strong. So we've been able to convert a substantial portion of the order book into revenue in the 2 quarters. So we are expecting a robust growth in the equipment business. We have guided 25%, but we think that we would be achieving beyond that by the end of the year.
No, that is visible. So this high run rate of 65%, will this continue in H2 also for equipment business?
we will be meeting our guidance and be over the above guidance what we have given, but it will not be a 65% increase year on year. But definitely it will be 25% plus what we have committed.
Okay, okay. And sir, for this same equipment business, company had earlier guided a margin band of 12 to 13% for FY23. But in this quarter, Q2, the margins are very high, close to 80-90%. So, sir, would you like to revise your guidance on this front, or what is the sustainable margin in this business, and why were the margins so high in this quarter?
For the equipment business, generally we work with a gross margin of anything between 40% to 50% and an EBITDA margin of roughly 12 to 13%. We have improved our EBITDA margins to about 14% this quarter and on a half-year basis, and this is going to sustain 14% EBITDA margins. And it's been a reason of the mix and the certain high-value orders, high contribution margin orders, which we have been able to get in the current period.
Okay, and this is supposed to continue this range of 14%.
Yes. Yeah. So when we had acquired the business, it was around 5% EBITDA margin. Through process improvement, setting up the processes, having alignment at both McNally and Tega, we are now seeing the fruits of what we had borne at that point of time, and we have been able to maintain a healthy margin of 14% now.
Okay. And sir, my last question was on Dynaprime. So, what was your Dynaprime share for Q2 and for H1 FY26? And what was the growth also for both these periods?
Sir, we don't give the breakup of Dynaprime due to being a sensitive information. But what I can commit to you is that the growth of Dynaprime has been anything above 20% north and above.
20% above in both H1 and in Q2.
You should see our business on an H1 because, quarter on quarter it's difficult to evaluate our business because of the spillover complexities, etc. So if you see on a full year basis, you will find the numbers we are telling you.
Okay, sir, got it. Okay, sir, thank you and all the best.
Thank you.
Thank you. Participants wishing to ask questions, you may press star and 1. The next question comes from the line of Mayank Bhandari from AM Securities. Please go ahead.
Sir, just checking one thing on the equipment side. NMDC order execution is started. Last time I think you mentioned that it is still the order, the execution order is not received yet.
No, we have received the NMC order and we have started the execution of the NMDC order. So the income will be booked both in FY26 and FY27 for the particular order.
25% growth guidance you are giving, this includes the execution of NMDC order in the equipment business?
Yes, it will include the NMDC revenue as well.
And so if I were to understand that was a large order of 120 crore, so is like the major contribution will come in 27?
It will be spillover between the two financial years. Difficult to commit exact numbers at this point of time, depending on the deliveries, what the customer expects at the site and at the timing of that. But what we remain committed is that McNally business will definitely grow 25% plus and above over last year.
And sir, we had also been talking about spillovers like in Q4 we said some of the deferment of revenues will be in Q1. Q1 again it was in Q2. So the 9-10% growth in this quarter in consumables, it includes some of the deferred revenue, is it?
It's a spillover, something from last quarter coming to this quarter going on to the next quarter. It will always happen like that, Manish.
Manish, this is Pratik here. We should look at the revenues, not just the revenue, but in the broader picture of revenues plus pending order, because that's the business in hand. It will depend on the timelines of the shutdown of your customers when you're delivering, as mentioned, because that's when the revenue recognition takes place, either on the dispatch date or on execution date, right? So it has to be in tandem with both the revenues as well as the pending orders. So it's a continuous process. So we have got orders in Q2, which will again get executed in Q3, Q4, and also in FY27.
So I'm just checking, Chile CapEx, I can see on the balance sheet CapEx for the first half is very low. So we still have maintained, and I think last call you mentioned $200 million for Chile alone and maintenance CapEx 50 crore and some expansion in the Dahej. So this year CapEx expectation would be how much then? Are we
Manish, it is not $200 million for this thing. The overall CapEx what we have committed is about in the range of $30 million to $35 million. If you see for Chile, a significant part has been spent on land, is lying in CIVIP, and even certain capital advances which has been given. So overall, if you see, we have spent a significant amount of cash flows, which will anything between 25 to 30% of my total project cost as of now. And as I told earlier during my starting of the call, the Chile CapEx project is on track, and we expect the commercial production to happen by September 26. That is Q2 of FY27.
I'm just asking, sir, this year FY26, what would be your total CapEx?
So it will be the total CapEx will be a function of my Chile CapEx, what has been capitalized. So it will be, I doubt till the entire factory gets commercial production, I'll be able to capitalize that in the books. But you will see the amount in land and CWIP to that account. The routine CapEx what we have is about a 50 CR, which includes my maintenance CapEx as well. That is what you can see on a capitalized basis. Manish, you are there?
Mr.
Hello. Yeah.
Deepak.
Hello.
Yeah, are you there?
I'm audible?
Yes, sir, you are.
Yeah. So most of my questions has been answered. I just had one bookkeeping question. So if I look at our depreciation expense, let's say in Q3 and Q4 of FY25, it was roughly around 26 crore. Now it has come down to around 22-23 crore. So want to understand why there is a deceleration in depreciation expense and what would be the quarterly run rate, let's say, going forward into this year.
The total depreciations what we have is in the range of about 45 to 50 crores what we have told. The depreciation expenses are account assets deployed at various manufacturing facilities and installation sites as well, which yield benefits to us beyond one accounting period. And the reduction of the same is mainly due to retirement of assets which have completed their useful life. So our CapEx, which includes is growth CapEx, sustenance CapEx, and specially designed self-constructed assets deployed at certain sites. And on a conservative basis, the same are depreciated over a shorter lifespan if required.
Okay, then this 22 to 24 crore run rate should continue going forward also, at least for this year.
Yeah, for this year it should continue. Once my capitalization happens for the Chile project and the Dahej debottlenecking project gets capitalized, then you will see a higher depreciation on these counts. But by that time, certain assets must have been retired, so that will also partially offset the increase in depreciation.
So the current participant seems to have disconnected. Participants who wish to ask questions may press star and 1. The next question comes from the line of Devarsh from SPL Family Office. Please go ahead.
Hi, I want to congratulate management for good result. I have questions around the Molycop acquisition. Am I audible? Hello.
Yeah, please go ahead, sir. We can hear you. Yeah, it's a little hazy, but we can still hear you.
Yeah.
There's a lot of background noise which is coming.
Yeah. I'm extremely sorry for that. After absorbing the Molycop, how will be our capital allocation currently shift between our deleveraging ourselves and CapEx?
Sir, we have not been able to hear you. Can you please repeat your question? There's a lot of background noise from your end.
I'm extremely sorry for that. After absorbing Molycop, how will the capital allocation priority shift between deleveraging our books or doing CapEx? Do you have any guidance on that?
Sir, we will be looking at, I can't give you a clear guidance at this juncture. We will be seeing the businesses and run them as separate verticals for both the Tega consumables, the Tega equipment, and the Molycop as such.
Okay. And the second question, can you give us any rough guidance about our 2027, FY27?
Not being able to hear you again.
Can you give us any guidance on our FY27 performance? Post-acquisition?
I would not like to comment anything on the acquisition at this juncture. What I can assure you is that for FY26, we stand by our guidance given that the consumer business will grow at about 15% and the equipment business shall grow at anything up 25% and north and above.
Okay. I do not have any further questions. Sorry. Bye.
Thank you. Participants who wish to ask questions may press star and one. I repeat, participants who wish to ask their questions may press star and one on their touchtone phone. The next question comes from the line of Varun Jain from Dolat Capital. Please go ahead.
Yeah, I said just a small follow-up. So, sir, this equipment business, you had, I think, earlier guided that by FY30 you expected to reach 1,000 CR run rate, right? So, do you see that happening sooner than that with this kind of growth?
We would be very happy to have a sooner growth to what you are saying. But to be on a conservative side, we will still maintain our stance that in the next 3 to 4 years, we will have McNally equipment business touching 1,000 crores.
Okay. And on this Molycop, sir, so sir, by which quarter do you expect the transaction to close and then we get the, consol numbers in the reporting?
Like we told earlier in the call, we expect the transaction to close anything between December or January. So quarter 4 of this financial year, you will have the first consolidation for Molycop into Tega Industries.
Okay. And from there onwards, the cross-sell benefits will start also appearing, with the mill liner and grinding media and all from FY27.
So these are all complementary products, and we expect certain revenue synergies, cost synergies coming in through this acquisition. And we will keep you in. We have given a detailed presentation on those things, which is available on our website, and we'll keep the investors posted of subsequent developments, what happens in this regard.
Okay, sir. Okay, that's all from me. Thank you, and all the best.
Thank you. Participants who wish to ask their questions may press star and one. I repeat, as a reminder, participants who wish to ask their questions may press star and one on their touchtone phone. As there are no further questions from the participants, I now hand the conference over to the management of Tega Industries for closing comments. Please go ahead.
Thank you once again for taking out your time and coming to our investor call. We'll keep you posted of any subsequent developments. Happy to interact and take any subsequent questions you may have. You can reach out to our investor department, and we will be happy to address in case you have any further questions. Thank you so much.
Thank you. On behalf of Tega Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.